This is Trepp Wire Week in Review for week ending June 11th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS Commercial Real Estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And joining us today is Mike Benz, Senior Vice President of our Banking Solutions. This week, more than 2.3 million new stimulus checks are on their way to select Americans, and the U.S. will donate 500 million vaccine doses to the world. In economic data, consumer credit had modest gains. Weekly jobless claims were slightly higher than expected, but did drop since last week, and continuing claims also dropped. But investors were watching the much anticipated consumer price index, which jumped 5% year over year in May. Manus, the inflation growth was the sharpest increase since 2008, and the core inflation number was the sharpest increase since 1992. But the market seemed to be shrugging it off.
It was an interesting report, needless to say, although the reaction was much more interesting, I suppose. Barron's over the weekend had said consensus estimates for the top line headline year over year number was 4.6% growth. What we saw today was 5%. The core number, according to that publication, was 3.4%. The actual print today came in 3.7%. So both numbers substantially over what people were saying were the expectations, yet by any measure, the market reaction was relief. The major stock indexes rose, not sharply, but steadily over the course of the morning, and they gave back some of those gains late in the day. But if that 5% number had spooked people, you would have seen probably a bigger reaction than you did. Maybe more notably was the fact that the yield on the 10-year really tumbled Thursday when the 10-year fell from 1.5% to 1.45% in the aftermath of the inflation report. So what does that tell you? It tells you one of two things. Either the whisper numbers were substantially higher than 5%. Maybe some people out there had fears that we could see a 6 handle. The fact that we didn't may have offered some relief. The other explanations could be either that people are starting to buy into this quote unquote transitory nature of the inflation bump, and or the fact that, the Fed really does have this under control, or, will, over the next, couple of years. So, but whatever the case is, higher than expected inflation numbers and a really benign reaction by investors.
Nothing makes sense anymore, Manus. Why would the 10-year Treasury drop? I mean, it had been dropping during the week. Maybe the jobs numbers, although they were decent, they weren't as off the charts good as maybe some had expected. Maybe that was a little bit of the sell down in yields. But if you have 5% inflation, I just can't imagine why the 10-year would be dropping. I'm sure there's some sort of technical reasons. I did see two interesting charts in the past couple of days. One was a personal income chart. It has two lines, one with government transfers and one without. And the personal income line was, growing modestly up until February 2020. And then it falls off a cliff, and that's the one without government transfers. And we're just kind of back now to where we were pre-pandemic in terms of income. And this is like average level of income over the past 12 months. This is from the Bureau of Economic Analysis and Deutsche Bank. The balance, or the income with government transfers, is 20 trillion or 24 trillion versus what it was before, which is around 19. So you have that's one thing. So we're 4 trillion up on income. So there's all this cash flying around the market. And then I saw this other thing, I think it was on Zero Hedge, and maybe they were quoting some bank analyst somewhere, but the amount of cash deposits in large banks are just off the charts right now. So much so that banks are asking their corporate clients to take money out and put it into smaller banks, or they're starting to pay lower interest rates on higher balances. So, maybe that's why inflation is not at 12%, because we've got trillions of dollars just sitting in deposit accounts. But it's kind of just a little bit of a funky story when you had the Federal Reserve come out and the federal government and just start printing money and printing our way through this crisis. But now you have all this excess cash just kind of sitting around. So at some point it's going to come out, or maybe not. Maybe if the Fed starts tapering at some point.
The one thing we do know is that low 10-year treasury is a great thing for commercial real estate values and other values as well, not just commercial real estate as well. And this may be more anecdotal than it is real, but I do feel that we're hearing less and less of these screaming headlines of incredible price increases for suburban housing, right? We saw that in February, March, and April. It seems, and this is just my vibe from, what I read in the local newspapers and I see in the headlines, it seems like, we're reaching a peak of sorts, and that may be giving people a feeling or a hope that this is both transitory, number one, and number two, that it won't become even more of a mania, or at least not a mania beyond the meme stocks.
Unless you're selling your used car.
Right. Or your used Wave Runner or RV or your Pokemon cards or your NFTs. I will say that from Rick Palacios, who's a good follow on Twitter, he follows the housing market. Austin home prices up 38% year over year in May. Now that's different from, Westchester County or New York City area, but I think there are lots and lots of markets that just have had off the charts growth.
I totally believe that Austin is up 38%. It wouldn't surprise me if Westchester was up 25% year over year. I think what I'm saying is, from this point forward, I don't think people are expecting a 30% increase from today to 12 months from now. It feels like it's kind of reaching a plateau, but then again, all bets are off in this current economy with so much liquidity and so much cash floating around, and a 1.45% 10-year.
A couple of other quotes from this guy. Again, Rick Palacios Jr. is a good follow on the housing market. This is from a builder in San Bernardino. They have a sense that we are nearing the capacities of our buyers with these price increases. And this is from an Orange County builder, raising prices to an unprecedented percentage increase, and our costs are still outpacing us. So the inflation on the cost side is still very, very much there. But luckily I moved into my house last year. So I'm closing on a mortgage next week, and I'm pretty mad that the 10-year has dropped as much as it has in the last couple of weeks.
Turning to office, we've got some green shoots and crabgrass because we do lawns, I guess.
Yes, it sounds like an Outlaws song, right? Green Grass and High Tides, classic from that band in the 1970s. But the truth is, we do have green shoots, we do have crabgrass, and we do have a new entry, which is the must know of the week. So we'll start with the green shoots, and we'll transition from the Outlaws to Sheryl Crow. I'm going to tap into one of her lyrics, which is, all I want to do is have some fun until the sun comes up over Santa Monica Boulevard. And the reason I chose that lyric today, I think that was Sheryl Crow's first hit, if I'm not mistaken, is what's happening in Santa Monica over the last 2 weeks has just been extraordinary. It is the greenest of green shoots. And let me rattle these off. The tech company Snap, which is the runner of Snapchat, which I don't have, but maybe I will someday. They took 140,000 square feet in a lease expansion with a Boston Properties office in Santa Monica. That was one of 3 or 4 big ones in the last couple weeks. The Santa Monica Business Park is a 1.2 million square foot campus at 3100 Ocean Park Boulevard. Another big lease in that city also goes to Boston Properties. Last month, they added Roku, which was about 72,000 square feet at the Colorado Center. That turns out to be just a small fish by comparison to what they got this week. Boston Properties inked a 7-year lease for about 350,000 square feet with Hulu. So between Hulu and Roku, over the last month, Boston Properties has added 420, 425,000 square feet renewals or expansions to their 1.2 million square foot office. Hulu had been a little bit of a concern because their lease was expiring at the end of this year. That particular property backs a huge 2017 loan. So people were keeping an eye on that in the CMBS market, but now Hulu's there for another 7 years at least. But you think I'm done? No, even more stuff going on.
Wait, were Hulu and Roku in the same building?
That's right.
That's very interesting because many people watch Hulu on their Roku.
There we go. That's
Next, you'll be getting Sudoku in that
should
building.
Make for some interesting water cooler conversation.
I wonder if there's a future merger there.
Yeah, it could be. So the last one I have in Santa Monica is GoodRx. You see a lot of their ads on TV. It's an app which allows you to find the lowest price on prescription drugs. They expanded by 57,000 square feet at the Penn Factory. That's an office in Santa Monica as well. That last story came to us by Commercial Observer. So just a lot of good things happening in Santa Monica right now in the office thing. And so when all those office workers drive their shiny Datsuns and Buicks back to the phone company and the record store too, they too will get to see new digs in Santa Monica. That's a little deeper cut in the lyric space.
For some reason, the song Hand in My Pocket from Alanis Morissette comes to mind. I was trying to look up the lyrics to see if there was some sort of connection, but when you mentioned that Santa Monica Boulevard, that's what came to my mind. There's literally zero connection.
There is none, I can tell you.
It just shows you that it brings me back to being 8 years old in my mom's car.
Well, it's funny. 3 of the 4 pop culture items that she references at the end, Datsuns, Buicks, the phone company, and the record store, 3 of those 4 don't exist anymore, right? They're gone. And this song was probably written in the 1990s, I guess.
Yeah.
80s, 90s, something like that.
90s.
Anyway, a little bit of Crabgrass, a couple negative stories that we highlighted in Treppwire recently. Houston again, 9990 Richmond Avenue. The special servicer comments for that loan indicate that the borrower has expressed a desire for the consensual transfer of title back to the lender. The collateral is a 190,000 square foot office. It was built in 1980, renovated in 2014. Occupancy was down to 67% in 2020. The loan backs a 2015 CMBS deal. Another one, this is a bigger story, the $100 million One City Center loan. The borrower has told the special servicer they will no longer fund shortfalls on the loan. This particular story has been out for a while. We've been covering it in Treppwire for many years. The property is a 600,000 square foot office in Houston. Many years ago, major tenant Waste Management announced it would be moving from that property to the Capitol Tower. It occupied 40% of the space in the One City Center property. The building itself, that One City Center property, backs $100 million split across 2 2015 CMBS loans. So that would be the Crabgrass, if you will, of the week. And then we have a must know. This is a new category that I think bump.
We need a sound effect for the must know of the week.
People that should know probably do know this already, but probably if you don't know it and you're in this market, probably taking some career risk. This story came from Steve Cuozzo of the New York Post, who has an interesting gig. On Tuesday, he writes about commercial real estate. On Wednesday, he does restaurant reviews for New York City. So it's a great gig. And he's a great guy, by the way. So his story this week was that hedge fund 2 Sigma is in the market for between 400,000 and 600,000 square feet of office space in Manhattan. So if you're a broker in Manhattan and you don't know this and you're kind of the big whale hunter, you should know this. But the article notes several properties that could be good fits for 2 Sigma, including 1740 Broadway, which we mentioned a month or 2 ago is losing L Brands as the dominant tenant there. The property that 2 Sigma currently occupies is in the Soho neighborhood. and it backs a 2015 single asset deal. So if you're worried about not having seen this story and you're listening to this podcast, we're happy to share Steve's work with you so you don't get shunned or stigmatized in the office for not knowing this.
Turning to retail, the National Retail Federation raised its outlook for the year, citing a quicker than expected recovery and an eagerness to shop, which is clearly welcome news for retailers.
Well, they're putting in a Trader Joe's right up the street from my house, which is going to be epically positive for my monthly retail outflows, but that's just on a personal level. I will say that, again, kind of vibe check anecdotally, you know, you can't find a space in the parking lots of Lowe's, Home Depot, BJ's. I can't tell you, I haven't been to any shopping malls, but like any sort of direct access retail centers in the upper Westchester area are popping, right? Even the bagel shop is popping. And a lot of people aren't wearing masks in the bagel shop, which is like just a nice thing to see people's faces again. You know what I mean? So I think people are dying to get out. The numbers I talked about in the beginning in terms of literally billions and billions and billions of dollars in cash just in people's checking accounts at this point. I think people are ready to spend, right? And there's, as much as Amazon has taken over the world, there's only so much you can continue ordering to your house. You're going to want to go, to the PGA Superstore and buy some new clubs, or you're going to want to go to here's where my bias comes in, right? All I can think of is like Dick's Sporting Goods and the PGA Superstore, but you're going to want to go to the Camping World and pick up the new amazing tent for your hike. Like, I just feel like there's so much money ready to be spent, and it's still a majority of that retail money is spent in brick and mortar. So I think we're looking positive for the future right now.
Well, the big theme this week for us in the research area was there was a huge wave in May of loans that were coming due, and now in June as well, early June, that we've started getting into remittance season. And these, $50, $100, $150 million loans that were made in 2011 and 2012 are now coming due. And we had several that we could talk about, and we'll get into why this is important after that. In terms of May, we put out our payoff report this week. The payoff report showed 3 big loans that were due last month that did not pay off, all of considerable size, a couple of them in CMBX 7. The biggest one was the $256 million Providence Place Mall loan. The collateral is almost 1 million square feet of retail space in Providence, Rhode Island. The loan backs a 2011 deal. The loan structure is part senior loan, part B note. The property lost a Nordstrom a year or two ago, but this particular loan, DSCR of 151 in 2020, which is not terrible considering we had a pandemic, and the Northeast was where we saw the most aggressive store closures. Occupancy was 84%, but that loan now moves into purgatory. We try to see what happens with that. The second loan, largest loan not to pay off in May, the $190 million White Marsh Mall loan, 700,000 square feet in the Baltimore area. The loan is split up into 2 CMBS deals, one of which is part of CMBX 7. In this case, even better numbers for 2020, a 2.16x DSCR, net cash flow DSCR, 93% occupancy. That loan now goes into purgatory, and 2 more to talk about. In June, we had a huge single borrower financing come due. It was a 2012 BBUBS deal, 4 loans behind it. It turns out that 3 of the loans failed to pay off. One on the Tucson Mall, Tucson, Arizona, and the Town East and Town West malls in Mesquite, Texas. In the case of the Tucson loan, a 186x DSCR, 93% occupancy. So what we're seeing is a lot of these properties, loans getting to their maturity date, the borrower not throwing in the towel because they're still cash flow positive, but unable to obtain financing. So we'll get into the importance of this shortly. On the other side of the coin, 2 properties did get refinanced. The $202 million Fashion Place Mall loan, Murray, Utah, that was part of that single asset deal I referred to, the BBUBS deal. It paid off and is being resecuritized in a new CMBS deal. And then Blackstone refied its Flushing Skyview Mall. So 2 positives, right? One is borrowers are not throwing in the towel, and for some properties, financing is available.
I was going to say kind of mixed messages, right? I guess it depends on the property, but I have to give a shout out to our friend Don Sheets. I took his session 1 of his distressed debt class that he offers, and it was great. There was a lot of very smart people on there and talking about cool stuff, doing a case study. But, he's got his, 5 things that cause distress in the distressed debt CRE space. And one of them is, the obvious one is property, then there's borrower, lender, capital structure, but one of them is macroeconomic. And it seems like some of these that didn't pay off, it's a capital markets issue. It's not a property issue per se, right? I haven't looked at them in depth, but if you're telling me that they're like, near 2 DSCR and 93% occupied, and the borrower's holding out hope and not throwing in the keys, then that just must mean that, there's just continued dislocation in the availability of capital for these types of assets, right? For debt capital on these types of assets. And it tells me there's got to be opportunity here, right? Like, so, maybe they can't get a SASB or a conduit loan, but there is tons of private capital out there probably. I wonder if they're paying attention enough to this type of stuff.
Well, 2 thoughts on that. Number one is, with this strong debt service coverage ratio, these things are really prime candidates for extensions, right? That you extend it for 3 years, you take the excess cash, pay down principal. Maybe the owner throws in a little bit more equity, $5 or $10 million to pay down a little excess principal, put some more skin in the game, and so forth. So that's a positive direction, right, for the credit side of CMBS, that you still have a borrower who believes in the property. On the other side of the coin, what we may have seen in the last 30 days is a turning of the worm in the derivative space. And this is a little bit of inside baseball, but over the last 3 weeks, we've seen the spread on CMBX 6 BBB minus tighten by about 300 basis points, maybe more, right? And there may be this sense now a little bit between the longs and the shorts that, yes, more of these guys are going to muddle through, or at least extend and try to muddle through, than maybe we thought about 9 months ago. And that may be a big driver of why we're seeing this spread tightening, considerable spread tightening in that CMBX 6 BBB minus.
We got to do a little deeper dive and see how much of that is due to the fact that the fashion outlets finally resolved.
Well, that could be it. That certainly could be it.
Prism,
but you got to,
fashion outlets, whatever you want to call it.
I think part of it has to do with, every one of these guys who's long and short is looking at these resolutions or non-resolutions in the moments that they happen. And the fact that there was very few indications this week, and certainly none of size in the retail segment, of people saying, we're throwing back the keys, probably makes the shorts a little nervous, right? That this thing is going to go out longer than Carl Icahn had hoped.
It's surely what we're seeing in the bank space or the non kind of securitized lender space. I will throw in one more nugget. I think I had seen this maybe a week or 2 ago, but we have it here, which is that CBRE is launching a new practice dedicated to mall repositioning, a specialized mall repositioning team. This is from Globe Street. I think we might have seen this somewhere else as well at some point. I just can't remember. It's here's the quote: using a data-based approach, mall owners are successfully repositioning properties for a wide range of uses, including multifamily, hotel, office, healthcare, logistics, or life sciences. There's never been a time where there was more opportunity for mall owners to get creative in order to maximize value. We've had this conversation over and over and over, but centrally located, they're usually there for a reason. They're usually like near a highway or, easily accessible to lots and lots of consumers, tons of parking, right? Tons of land. So whether you reposition the building as is, or you kind of chop it up and turn it into something else, there's got to be value there, especially given the locations of these things.
Let's do the deal of the week.
This is different from the must know. This is the deal of the week.
If you show up at the water cooler not knowing this one, you will not be scrutinized or
chastised,
victimized.
I feel like I'm Clyde Frazier and you're Mike Breen. I got to wear some suits like that. I got to get some suits like that.
How great would it be to be like a guy that could pull that off with confidence?
Manis, swishing and dishing, commercial real estate stories.
I'm thinking more of the fashion side of it, but it's funny. Yesterday, I went to a barbecue place up in Westchester, and I wasn't really thinking. My son said, you want to go get barbecue? And I said, sure. And I pulled on my sneakers and I got in the elevator and we were leaving. And he turned to me and goes, "You've totally given up, haven't you?" And I looked at myself and I saw like the shirt I was wearing and the gym shorts. And I said, I kind of guess I have. Or it's either that I've given up, maybe I have given up, or, I went so long not expecting to see people that I thought it just doesn't matter. I don't know.
Hold on. That actually happened to me today. I got in the car after I dropped my kid off at school. I went to the bagel shop, got my normal routine, get in the car, pop open the coffee and the bagel. I look down and I've just got stains all over my shirt. And I'm just, you know what? It's just the way of the world now. We're gonna have to go to Kohl's and re-up. So I actually got a loyal listener texted me last week and said it was the top 25% of episodes ever, which I don't know if I agree with or not. I can never really judge our own stuff. But he also mentioned no Kohl's reference last week. So come on, we can't forget that.
So with the deal of the week, we will run it back to office. We usually try to pick something which is encouraging. And as a result, most of our deals of the week have been about hotels or retail, but this one is office. And the reason I chose this one is it's a DC lease. The story comes from Biz Journals, and the article noted that DC last year, downtown DC, had a 17% vacancy rate, and there were millions of square feet, like in many other cities, up for sublease, 1.1 million in negative absorption in the first 3 months of this year. So all of that is from Business Journal's great reporting there. But they broke the story that Innovational Corp had inked a nearly 100,000 square foot lease in downtown DC. It's at 1400 L Street Northwest in the Alec building. That particular building is owned by the Meridian Group. They had acquired it a couple of years ago from Mac Cali. For those who don't know, and I didn't before I looked up this story, Innovational is a builder of web portals and mobile apps for Apple and Android. 100,000 square foot lease is certainly nothing to sneeze at, especially in the current times. Who do we give credit for here? So Tim McCarty and McKay Elliott, they worked with Acreage to represent the tenant, and CBRE's team of Mark Klug, Scott Frankel, Carol Kavanaugh, Emily Eppolito, and Dimitri Hadjimahalis pulled that deal off. So congratulations to all of them. And as I said, we always like the green shoots in markets that have been hard hit. So congratulations to all involved.
Manis omnipotent with the pronunciation tonight.
That last one, with all due respect, I had to work on that a few times. Like I'm tired of butchering people's names. So I really, took a glass of water.
That's why it's better when we get the deals of the week submitted from listeners and they actually tell us how to pronounce their names. We've gotten that many times. So
yes. And for a guy, named Manis, who has heard that name pronounced a million other ways, I'm sympathetic to those who hear their names mispronounced.
So turning to banks, Mike, you're starting to see a regulatory shift in the market, one that we haven't seen in the past 4 years. Give us a quick view of what it's been like.
Yeah, thanks, Martha. And thanks for having me on. I'm definitely excited, loyal listener, big
First
fan.
time in a long time.
Well, yeah, exactly. I have to apologize for the listeners in advance. Last week, you guys are talking about toga parties, and here I am to talk about accounting standards and regulatory shifts in the banking space. But
In a toga.
In a toga.
It's a lovely toga, Mike.
Just full disclosure, my gauge is how many conversations our banking solutions team has had with banks that were regulatory driven in the last 4 or 5 years. So in the last 4 years, they've been few and far between. In the last 6 months, we've had several, right? So there's definitely a shift, and my gut is that it's for a few different reasons. We are about 1.5 years into banks following FASB's new accounting standard for credit loss reserves called CECL. While that's not a regulation, it's a standard that banks are following. It affects the reserve. So regulators are starting to pop the hood a little bit and ask them some questions about the models and the data that they're using. We're hearing some call, we're getting some calls and having some conversations regarding that. We also a lot of our clients have been anticipating a shift with the new administration, right? In the last 4 years, we haven't had a lot of conversations that were truly regulatory driven, but with the new administration, there just seems to be a feel of more regulation. And as a result, we are having more client calls with banks that are asking for data and analytics to kind of combat the questions that they're getting from regulators.
Well, let's face it, that, the intersection between commercial real estate, banks, securitization, and regulators is very tight. I mean, for people that are just in CRE or just in banking, perhaps, the banking guy doesn't know about securitization or the broker doesn't know about banking per se, but you can't take an unsettling or an earthquake in the economy that affects banks without it reverberating to everything else. And in the early 80s, when interest rates spiked, we saw a huge jump in bank failures. Banks were holding on to 6% loans and they were paying short-term deposits north of 10%, negative arbitrage out the wazoo. That spawned the residential MBS market, which allowed for better duration matching, among other things, right? The ability to get assets off your books and not have asset liability or interest rate liability mismatches. The lending excesses in the CRE market in the late 1980s gave rise to the RTC and ultimately the CMBS market. The great financial crisis brought on Dodd-Frank and stress testing, model building, and you could say indirectly CECL, because it's another form of measuring losses. Joe knows his stuff in spades, guys building default models top down and bottom up. And I think that there's this feeling now that we've gone through another cycle that everything that we knew in 2012 doesn't have to be thrown out the window, but it has to be added to, right? We've now have this black swan event out there, and all these models are cumulative. Interest rate mismatches first, illiquidity next, inflated valuations, a bubble next, and now we have a black swan. And I think between all of those parties, right, the banks, the regulators, the lenders, et cetera, they're all looking at these things and say it's probably ready to time to put the band back together, get our modelers to look at all the data that came out in the last 18 months and come up with a new and better model, which says, how do we look at this now?
Yeah, I think, I don't have such a sage and long experience in this space as you do, Menace.
Well, listen, I was singing Lou Rawls before, and none of you guys knew who Lou Rawls was. So.
Wait a minute. Come on.
However, I was knee deep in post-Great Financial Crisis stress testing and model building and PDLGD and all that type of stuff. And I will say that there is an ebb and flow to these types of things, and it's definitely driven by the administration, but it's also just driven by the market and the natural kind of aging of the things that get built and the models that get built, right? So, 20 2011 through, let's say 15 or so, was holy moly, we have to build this entire infrastructure of stress testing and models and everything else, and all of our data is a mess. This is the banks I'm talking about. We can't find the data, we don't have the data, blah, 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 right? So they had to go to people like us and others, or get consultants to do a lot of work for them and all that type of stuff. And it took them many years to get it kind of buttoned up, right? And then they were operating those systems and models and doing CCAR stress testing and CRE concentration stress testing and everything like that for several years in a super benign, low growth economy. We had some blips here and there in 16 and 18, but now I think this probably would have happened in some ways anyway, but definitely given COVID, everyone is turning around and saying it's time to reestimate, it's time to recalibrate. And they're also saying, well, we were expecting all of the models that we built to be useless during COVID, but actually they weren't that bad because the total losses and the total defaults have been way, way, way lower than, what a human brain would have expected, right? And I think some of the biggest issues with these models during COVID was the fact that any model out there is really not probably calibrated to have unemployment rates go from 5% to 14% in a month, right? Or for GDP to go from 2 or 3% annualized to like minus 25, right? So some of that kind of like black swan shock stuff that we used to say, hey, listen, you got to run this, but it'll never happen. Like kind of did happen on the macro scale, but the losses never materialized. So
Mike, give us the kind of the order of concern for the guys that you talk to, for regulators. Is it getting CECL done and ready? Is it the belief that losses that are coming out of their CECL models are higher than they think they should be? Or is it more on the credit side, which is, wow, we need to recalibrate because, this is a harsher scenario than anybody ever predicted in terms of shocks to the macro side, as Joe said, unemployment, negative GDP, et cetera. Give us the lay of the land as you see it.
Yeah, I think it's a combination of all of that. I don't know that I could prioritize them. What I do know is that the data that the modelers are going to be using is different this time around, right? So last time around, and Joe could talk to this because he used our data to build the model. It was a little bit more straightforward, right? Like LTV and DSCR were big drivers of whether a loan was going to get into trouble. Payment history was, whether the loan was delinquent, obviously was a huge driver. And now we're not seeing as much of that in the data, right? We're seeing loans that aren't technically delinquent, but banks are changing their risk rating on that loan from a 2 to a 7. So why would they be changing the risk rating from a 2 to a 7 if the loan isn't in trouble? So I think the modelers are just going to have to look at different data elements. And that's probably what the regulators are asking them about, is what data are they using? What data are they looking at? And how is that affecting their models?
Yeah, it's an interesting thing that 10 years ago, really the only source of data that people could use was CMBS data. It's extraordinarily granular. You get hundreds of pieces of data per loan, from physical to top 5 tenants and NOI and occupancy and debt service coverage ratio valuations and so forth. So it's perfect for model building, but a lot of the banks would tell us, we wish that there was another source of data out there. So we've spent the last 10 years building a bank set of data to complement what we have. And what Mike was referring to a second ago with these risk ratings is that part of it. We now get from the banks risk ratings, which, is really an indicator of whether they believe a loan is going to default, whether or not it's delinquent or not. So from Trepp's perspective, as we update our own models, we'll be using that data to recalibrate in this post-pandemic refresh.
Some of this stuff is, I don't want this to sound bad, but some of this stuff is the regulators putting the banks through the paces, right? Like they want to make sure that, and we're seeing it more and more with our clients. We're getting calls from our clients asking us to provide them with more information, more explanation, more documentation about the data or the models or everywhere in between, because the regulators are kind of asking them those same questions. And a lot of times these are not questions that can be answered. It's not like the regulator says, hey guys, what's 1 + 1? It's more like, hey guys, why do you think that this type of model and this methodology and everything else is relevant for the way that you lend? And there's no perfect answer or no, 100% correct answer to that, but it's just the matter of, I think, if I'm looking at it optimistically, which normally I don't, I think it's saying if we put these bankers or these risk managers through this kind of scrutiny, it will help them to mo better understand what they're doing, better understand their underlying portfolio and the risks in that portfolio. On the other side of the coin here, and we've probably lost about 3/4 of our CRE listeners, but that's okay. And the other side of the coin here is, how do you build a stress test risk model in the age of unlimited Fed printing and unlimited stimulus, right? So like the way that the Fed and the government responded to this pandemic economically and fiscally was just, I don't want to use that U word. That U word that everyone's been using this whole time, unprecedented. I don't want to use that word, but I just did. Like, if you're building a risk model, do you layer in this idea of like, well, if it gets really bad, if it goes beyond a certain level, then actually it's not that bad, right? Because we're going to get TDR relief, and we're going to have a bunch of CECL reserves to draw down from, and we don't actually have to make this guy pay off. It's confusing and it's fuzzy, and that's the world we live in.
Well, I'll go even further in terms of trying to lose our client base, our listenership. And
if we could get down to only like one listener that makes it all the way through the entire episode,
5 of us right now.
Yeah, that's right.
And
when we were building our own model 10 years ago, an important element of our own model was liquidity. And, we came up with liquidity measures that would inform us in looking back at our data as to whether the loan was made during an incredibly liquid time, like 2007, or a fairly illiquid time, like 1994, or that would be extraordinarily illiquid. And hopefully those same measures that we put in place back then will reflect these times right now being incredibly liquid. And by that, what we mean is, if a loan is originated during an incredibly liquid time, we are assuming in our own model that we are at peak valuations or close to peak valuations, versus a loan that's made when things are illiquid, that you think the valuation of the collateral is on the lower end. And so that's, that's all there.
Manus, I'm getting chills hearing you say this.
Yeah.
You know why? It's giving me like, I'm reminiscing of the old days.
Yeah.
Right. Of the 2015, 2016 time when you, me, and Mike used to just kind of like stroll into the bank and tell this story. And I remember you talking about the liquidity score. It's like, yeah, man, time flies, right?
I could see Joe right now. He's thinking R, which is a programming language, or, database language. And he's thinking R.
Wow. We really jumped the shark here.
Sassy. Heyo.
Wow. Joe, you're not old enough to think of old days.
Only a statistical nerd will get that pun.
Yeah. If I were going to give two pieces of advice to people that, we're talking to Mike about model building and stuff like that, based on our 10-year ago experience, one would be, do not leave it to the end. Do not think you could build a model in 90 days, because as we saw with some of our clients, that was a recipe for a disaster. And number two is, never build it in a vacuum. Build it with, constant dialogue with your regulator, your accounting firm, other people in the industry, and so forth, because we saw that too, where people built a model kind of in a vacuum and presented it to the Fed, and it was just kind of not at all what the Fed was looking for, and they had to go back and start from scratch. So
and multiple data sources. I know, Manus and Joe, how many times can you go back and count the amount of times that we said to a bank, you have to use data outside of your backyard, and banks in New York would say, well, it's New York, right? Loans are never getting into trouble in New York. Values never go down in New York. And we always said one day New York is not going to act like New York. And here we are in a pandemic where New York is not acting like New York, right? So it's important to use additional data sets and as many as you can get your hands on.
Certainly not in the hotel space, that's for sure. That's going to be a whole new area for mining.
I don't want people to feel like we're trying to sell them on anything. We're really not. We're just trying to tell you what we're seeing in the market right now. And the reason that it matters, I think, is kind of going back to Manus's point from a few minutes ago, which is that when regulators or accounting bodies bring out new regulations, new rules, or they just start putting more scrutiny on their regulatees, which would be the banks, that does flow through to the real world, right? It flows through to the types of loans you can get as a borrower, the types of loans you can broker as a broker, how much leverage you can get, how the banker is going to be looking at your property, because now not only does he have to sell it to the underwriter, but he has to sell it to the originator. He has to sell it to the accounting group who knows the moment that he originates this loan, they're going to have to associate some expected loss on it, which goes directly into the income statement. Changes in CECL reserves go directly to the income statement. So that doesn't mean you stop originating loans, but there may be some differing ways that banks are looking at these types of loans when they're coming onto the balance sheet.
So one last question on this topic, and that is that CECL, obviously for smaller institutions, isn't going to be instituted until 2023. So what have we learned by watching what the large banks have done over the course of the last year, if anything?
That's an interesting one because FASB just held a roundtable where they got feedback from banks about how they thought CECL went for the last 18 months. And overall, the theme was that it worked. I can't confirm or deny that. When we talk to clients about CECL, we just say, hey, we have solutions. We didn't write the standard. It may have worked because of CCAR and DFAS and the capital rules that were set into place years ago. But the overall theme is that it worked, but the banks don't agree. There was one lender, I forget the exact quote, but he said something like, this was the most stupidest regulation that he ever had to follow, something along those lines. So you could see the difference between what the banks think and what FASB thinks himself.
Yeah, I think the big difference is going to be that the next wave of banks that have to abide by this standard have much lower budgets for these types of massive changes in processes, right? So a JP Morgan or a Wells Fargo, they had been building models and they have whole floors filled with quantitative analysts and all stuff like that, right? So they could say, hey, you 30 guys, you go figure out CECL for the next 2 years. And that's what they did. And they get, they use models and data and all this other stuff. But, for a regional or, a community bank who has to abide by this standard, they don't have that type of resource. So they're going to be turning a lot to simpler methods, right? So instead of building very, very big fancy models, maybe they're going to rely a lot on historical loss data, right? Historical default rates. And that's going to come from their own information and also from third parties. So it'll be interesting to see the type of scrutiny that auditors give to those banks on their CECL reserves, because you can't really expect them to be doing, incredible amounts of work to get to that number. But again, in our experience, sometimes you talk to a really small bank and they have an incredible quantitative kind of like sophisticated team in place to do these things. And sometimes you talk to a larger bank and they have like one guy in the back room, right, with a Post-it note. So it's kind of expands the gamut.
And whether you agree that CECL worked or not, from a timing perspective, the large banks last January implemented CECL. Their reserves were significantly higher, and they were prepared to weather the COVID storm over the last 18 months. You can't deny that.
It was a totally fakakta time for CECL to happen, though. Most of the banks actually scrambled and created some disclosures which said, listen, if there wasn't a COVID, here's what our CECL reserve would have been, right? We increased it by whatever, X billion dollars, but then, double that due to COVID, right? So we covered that in Q1 of 2020, all the way back in the day, or the end of Q1 2020, back when we started this whole shebang.
So let's turn to the shout outs, of which we have a flurry. Steve B shared our episode 85 and gave us a shout out to the entire Treppwire team, said it was as entertaining as always. Matt O loved the show, was looking for sheets info, which we provided. Susie S wanted to say she loved the podcast and happy anniversary to Treppwire, and wanted to know, Manus, what size linen shirt from Kohl's you would like to help you celebrate. So I thought that was very nice. John G, otherwise known as Key Lime Johnny, had a nice comment regarding your lifeguard story last week. He said he was an ocean lifeguard during his summers in college in Long Island. Greatest job ever. Pay was mediocre, but the fringe benefits were phenomenal. He didn't expand on that. Given that experience, I must state unequivocally that your condo pool job is probably one of the least desirable lifeguard jobs in the area. So I don't know if we take that personally, Manus, but you have a chance to defend yourself.
Eli John has never seen me in a bathing suit. He has no right to throw, stones in this glass house.
Joe D commented on Twitter about the toga party, and as Manus said, he'll keep it G-rated. Victorian landlords on Twitter, Trepp data will be vital to track how 103 million feet of vacant commercial office space is used. So thank you for that. This summer is expected to be a busy travel season. As we've all talked about, people are busting to get out, but the airlines are now short-staffed and have started asking their corporate employees to pitch in at airports and lounges. And unless you're flying first class, on some airlines, there's no alcohol served in an effort to quell passenger incidents. So I don't know what you guys are doing this summer, but if you're flying, you might have to bring a snack.
I'm flying in 2 weeks, and if there's a brawl that breaks out on my flight, I can guarantee you that my 2.5-year-old son will be all about it. The kid, all he does is punch me in the face. So he's ready for this flight.
Tough.
What a thankless job, by the way, to be a flight attendant at this point. It used to be all like, glory and like, look, I get to travel all over the place and be on these comfortable flights and smoke my cigarettes. I mean, can you imagine? And now, you have to be breaking up fights and ending up on TMZ.
Or getting punched in the face yourself.
Exactly.
Flight attendant last week.
God bless them. With that, we'll close. Thanks, Mike Benz, for joining us this week. And thanks to our producer, Haley Keene. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or a comment, send us an email to podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.